Welcome back to Golden Rule Radio. We're going to start this week's show by asking when the stock market bubble will burst, because the stock market does not seem to be reacting like gold and the dollar are with the announcement that John Taylor is now part of the five in the running for the Fed chairman.
Robert, why would you even ask the question? According to the University of Michigan study that came out this week, it's never going to burst. We've never in American history been more bullish. So why are you talking about a burst?
Because John Taylor is a hawk, and Trump came out and lauded his resume and thoughts, and he is in the running for the next Fed chair. I think the markets are going to decide which way they want to go when Trump does finally announce his decision for the Fed chairman, I think before November 3rd, what else is happening on November 3rd? Aren't we going to be doing a briefing in Kansas City?
Yeah, we are. That's the night, a Friday night. You should absolutely be there if you can, if you're in that region. Hear Don and David give an up-to-date geopolitical, monetary, and economic briefing. But Miles, going back to what Robert just mentioned, somebody being hawkish, what's a hawk versus a dove in central bank lingo?
Doves eat trash, hawks eat doves.
That's insightful. That's not what I was looking for. But look, a dove is somebody in central bank policy that believes that lower interest rates is better. It stimulates the economy, and so they're the ones over the last decade that have been trying to drive interest rates down. That's their emergency response level to try to stimulate the economy. A hawk believes the opposite, that you need higher interest rates, right, for the benefits that it brings, and to certainly bolster the dollar when it's becoming too weak.
In fewer words, I'd just say it has to do with the leniency or strictness to monetary policy.
Yeah, the easiness of credit. You could put it that simply too, with low interest rates. How much are you trying to get people to borrow?
So the question here then is, are we bringing people like him in? Are we bringing some potential hawks in?
That's right.
Purposefully, with the expectation of actually having them step on and do that job that's necessary? I mean, for the last number of years, you've had a number of Fed presidents across the country all voting for a more hawkish, a tighter monetary policy. So are we actually bringing him into the running because the government is looking at that as an opportunity? Or is this just one of those things where we show multiple candidates, even though we know the direction that we're going to go, which I believe is going to be continued monetary leniency?
I agree with that, and I think that means for the markets that the dollar would continue to slide down the water slide that we're talking about if what you're saying, Miles, that dovish behavior is still going to be the monetary policy that the Fed injects. Mm-hmm. If we get a hawk, the dollar would probably rally. I think the markets right now are reacting, well, at least gold and the dollar are reacting to the potential for John Taylor.
But the stock markets aren't.
Exactly. The stock market continues to go higher, Dow Jones above 23,000. But I want to point something out, that Goldman's equity investments and trading seem to be taken over by a morph into a more private equity firm-oriented type of behavior, as well as Morgan Stanley has been cashing in on risky stock-backed loans. These are loans that are backed by stocks and bonds. They use stocks and bonds as collateral. Morgan Stanley's income from securities-based loans is up 18% from last year. What could possibly go wrong if you're lending money and backing it by stocks and bonds who have, right now a great behavior as the stock market rises? But what happens when the stock market sells off? It creates a trigger mechanism within a computer system that forces that liquidation.
Well, that's exactly what happened back in 08-09, right? We had the first stage of the sell-off in the equities market, triggered margin calls, which ended up causing that second massive drop in the equities market, bringing it down, 45-50%. I think a lot of people remember when gold went from the 1,050 mark up to over 1,900. And we remember when silver went from about 20 up to over 49. What a lot of people don't remember is before that happened, gold went below 700 and silver dropped down to about $9.
Miles, it's actually a great point, because the other fundamental to Robert's point is the importance of owning the tangible metal shows you that if you're properly diversified, you don't want to be fully exposed to the spot price, right? If the stock market were to crash tomorrow, that doesn't mean that the metals prices are going to immediately have the inverse movement. We did see them follow the stock market initially. Gold did come off 28%, right? So when silver dropped from 16 to under 10 in that same time frame, what we saw was that the physical market stopped. The real market was the physical market. You couldn't buy a silver American Eagle for under 16. It didn't matter what the spot price did. An MS63 double eagle went up 43% while the bullion coins dropped 28%. So diversification is key, and just know that it's all about owning the physical if you really want to have a hedge against a stock market collapse.
And we're not talking about a stock market collapse today or tomorrow. I mean, possibly it turns at any point. We're talking about the potential for a hawk coming into the Federal Reserve, the potential for the dollar rallying, the potential for easy monetary policy that has been the mantra for the last number of years changing. If that changes, the stock market could have a negative reaction to that. But, all things are great in the stock market today. We're just talking about the potential for the risk that's there tomorrow.
And the president does have the ability to determine economic health and viability, right? There are some things that he can do budgetarily, executive order-wise. But what has occurred since 2008 and that crash, we are where we are today strictly because of central banks. It is central bank policy that has determined debt. It has determined interest rates. It has determined where monies go. It has propped up the bond market. So this isn't one world leader that's doing all this. So if you're putting all your eggs in the Trump administration basket, you really have your eyes on the wrong ball. And there is so much language coming out of central banks since really last Thursday, you guys, where Kuroda from Bank of Japan is saying that he really doesn't think they have too much of a position in Japanese ETFs. They own 75% of Japanese ETFs. You talk about propping up a market, right? European Central Bank shows no signs of any time soon. They've actually said that their accommodative policy will continue into the unforeseen future. Federal Reserve, Janet Yellen comes out and says prices really aren't that historically overpriced. Are you kidding me? Like, if you're not in tune by going to the grocery store and the gas pump and any store really that you're going to and feeling the true effects of inflation, get ready because you haven't seen anything yet. What they're saying is inflation has a long ways to go and they want to see it go.
So we look at the market reaction back in 08, 09 at just a whisper of hawkish monetary policy. What if, as Robert suggested at the beginning, we have somebody come in who actually pursues it full bore?
We'll see. Looks like November 3rd is the date that's been set for that decision. So
Robert, good point. Let's just not forget that Janet Yellen's still in the mix here.
Yes,
you
she
have
is.
an incumbent, the devil you know, and then you have four devils you don't know, a couple doves, couple hawks. We don't know where he's going to land, but you guys, we got to wrap up and let's get into the metals.
Well, you
and
say
bring in
devils.
Miles.
I mean, you're not really referring to them as devils. That's just a saying, right?
I'm not.
So we're between levels on a lot of these precious metals charts, so I'm just going to run through them rather quickly this afternoon. Gold did come up and just scrape that 1306, 1307 level. We did not go above it. I think we're coming back down to the 1263 point that we put in last week. So keep an eye out for that. Silver also followed suit, coming back down to that long-term declining trend line that we've been watching for a while. It's going to play there here probably for the next week or so.
Is it right on it?
It is right on it.
Okay. It being right on it, it will be fun to see if it stays above.
Agreed.
Like you mentioned last week.
Platinum also came down an equivalent percentage. However, palladium put in a double higher top while everything else was falling. We're showing some pretty aggressive bearish divergence against that bullish trend. So I actually would expect once we see those lows put in gold, silver, platinum, I would expect to see palladium actually take a little bit of a sell-off while those other metals end up turning back up in the next week or two.
Palladium selling off pretty hard today, over 1.5%. So
I had a listener ask me yesterday if palladium could actually go further. And yes, in 2001, we did see it actually become worth almost twice the price of platinum. We're not
Very
calling
short
for
term.
that. Very short term, one-time previous historical event. Don't bank on it.
And it's always possible that everything has changed in the automotive business and the demand for palladium and platinum, but we'll see.
So that's going to just about do it for Golden Rule Radio this week. We thank you guys for stopping by as usual. If you like what you heard, give us a thumbs up. Click that subscribe button. Make sure to engage in the comments. Stop by Twitter at ICA Gold. And as usual, if you have questions, give us a call at 1-800-525-9556.
Guys, I'm going to say in the last couple of weeks, we've had far more calls from listeners. Keep those coming because it really enables us to fill in the gaps for you. Don't wait for the next show. Just call and pick our brain. There is absolutely zero pressure to work with us, but we love speaking with you.